Tough to take any direction from August here. I mean, in the spirit of Terrell Davis just being here, if the Giants are undefeated in preseason, it doesn't mean they're going to win the Super Bowl, right? I mean, August has many, many different signals. But here's the signal, Melissa, that we're taking. First and foremost, the veracity of the yields and how they've fallen. Yields have fallen in August by the most they've fallen in almost 5 years in August. So for us, it's reduce some equity risk, okay? And in order to really take your equity risk much, much lower, you have to believe three things. First, that the Fed won't be successful in getting this economy to stay at trend. You have to believe that. We don't believe that. Second thing you'd have to believe is that there is actual political will for a trade war. Actual political will for a trade war on both sides that's going to affect growth and earnings. We don't quite believe that. The third thing, Melissa, that's really important, U.S. consumer. We believe that the U.S. consumer is the strongest they've been all cycle. So you'd have to take the other side of that to reduce equities even further.
The first one is interesting because that implies that you believe that the Fed can use monetary policy to offset any impact of a trade war. Is that what the core belief is at J.P. Morgan?
So Jerome Powell does not have the tools to really fight against an all-out full trade war, which leads me to the second point. There has to be political will for that trade war. I think what Jerome Powell is saying is that inflation is slipping, and they're going to have some sort of mid-cycle adjustment in order to...
But the key theme to all those three things are that you don't believe there's political will for a trade war, and so therefore it won't get worse.
And that's right. Okay. And we're looking at this kind of cautious stalemate. I think 2s10s is something, though, to watch, right? Sure. But three really important differences this time that 2s10s have inverted. First thing, the Fed is priced to ease now. In the past three inversions, the Fed was tightening post-inversion. Second thing is the $17 trillion of negative yielding bonds. We've never seen that before when the curve has been this flat. And then the third thing here is, the economy at this point is really just at a trend level, and we're not expecting that to fall much further.
Jim, I want to go to you. In your allocation, you recommend a moderate overweight to risk assets. So does that mean that you don't think things will get much worse, despite what the yield curve is telling us?
We don't think things will get much worse. And let's talk about the yield curve for a quick second. So if you believe that an inversion is a predictor of recession to come, the only two major markets that have an inverted yield curve today are the United States and Canada. So if you think that this is a real clear predictor, you've got risk in only those two markets, that doesn't make a lot of sense. But we do want to have protection against the trade war. We think that's going to persist for years to come. So we're overweight U.S. equities and underweight emerging markets. We want interest rate sensitivity, so we like real estate and infrastructure. And we still like high-yield bonds. And high-yield bonds are another signal that the yield curve is not telling us we're going into recession. High-yield spreads at 4% today are at half of the level that they were back in the first quarter of 2016 when we were really worried about the risk of recession.
Jim, if you're not worried about the U.S. economy, why do you want to be in interest rate sensitive parts of the stock market?
Just because there's such a flood of money into the yield-seeking assets globally that it's really supported real estate, really supported infrastructure. And if we're wrong, those assets have less downside risk to them than traditional equities. So it's a way to hedge a little bit of the risk in the portfolio, but also a reflection of the fact that we think rates are going to stay low for a long period of time.
Your belief that the trade war won't get worse, does that sort of diminish or does that weaken as every day passes?
Well, I think, Melissa, you can say that it can't get much worse, but it also can't get much better.
It can't get much worse. It can't get much worse.
No, but I'm saying that there's a limit between how far it can get for President Trump's reelection bid, right? I think that's the key here. And when pushes come to shove, what we've seen, whether it be the Huawei extensions, whether it be the September 1st extensions, that has happened, and it hasn't really been something that has been pushed to an escalation point.